Thanks for clicking. All eyes were on the Bank of Canada this morning as the bank was set to make its interest rate announcement, with many predicting rate hikes in the range of 50 to 100 basis points. We received our answer first thing this morning, with the bank hiking by 75 basis points, bringing the policy rate up to 3.25%. In the statement provided by the Bank of Canada and the rate announcement, they noted that we should expect more rate hikes in the future in order to calm down our inflation rate. Prior to the rate hike, CIBC had predicted that the bank would be raising rates by 75 basis points and that we would see the bank pause on its rate hiking cycle thereafter. Yet others are warning against wishful thinking, noting that inflationary pressures, including growing wage demands, lockdowns in China, a continual war in Ukraine, higher energy prices, and not to mention negative real interest rates, will force the Bank of Canada to continue to raise interest rates for the foreseeable future.
You've gone off your nut.
Indeed, in the run-up to the Bank of Canada's announcement, we've heard from multiple sources that the Bank of Canada will top out at a policy rate of 3.5% by the end of the year, which, given today's announcement, doesn't exactly seem to be the case. So what I want to do today is go over the Bank of Canada's announcement, discuss those predictions saying the bank was going to top out at 3.25% by the end of the year, and then I want to look at those arguments saying not so fast. Continual inflationary pressures will put more pressure on the Bank of Canada to continue to raise rates for the foreseeable future. All of this, as we'll see, is highly dependent on Canada's inflation rate, which is set to be released on September 20th. We'll obviously have updates out on that inflation rate on this channel. Click like and subscribe to get those updates. But for now, let's get into the bank's announcement. As mentioned, the Bank of Canada raised rates this morning by 75 basis points. This puts the policy rate at 3.25%. So is this the end of the bank's rate hikes for 2023? CIBC seems to think so. CIBC's managing director and head of fixed income, Ian Pollock, said the bank expects a narrative shift coming from the Bank of Canada following the rate hikes this morning. Pollock says that we should expect the Bank of Canada to be far more focused on the data rather than rhetoric going forward. This sentiment was echoed by Avery Sheffield, chief economist at CIBC, which said we should expect the Bank of Canada to be focused more on inflationary trends and the employment data going forward. So CIBC is saying that for at least the last 5 months, the Bank of Canada has been focused on rhetoric, on changing minds, on changing inflationary expectations, on making sure Canadians understood that the bank would be getting inflation under control. However, now that the Bank of Canada has brought the policy rate up over 3% in relatively short order, they will now focus on the inflationary data and take a wait-and-see approach.
Don't you feel ridiculous now?
Others are saying that when the Bank of Canada focuses solely on inflation, it's not going to like what it sees. The argument is that wage pressures are going to be a real factor in our inflation rate going forward, as workers attempt to recoup their lost buying power after nearly a year of higher than normal inflation. Indeed, we've already seen wage pressures growing throughout the economy, with the average raises granted in 2022 averaging out at 5.2%. Those higher wages are going to translate into a higher cost of goods, which will translate into a higher inflation rate. And this is going to put even more pressure on the Bank of Canada to continue to raise interest rates. John Paul Lamb, an economist at the University of Waterloo, noted that if the Bank of Canada doesn't get inflation under control, the wage pressures that we're already seeing throughout Canada are going to grow even faster. Further, Lamb notes that lockdowns in China, shortages of raw materials, and supply chain problems are going to continue to put upward pressure on the inflation rate. Not to mention that real interest rates are still negative. Canadians can still borrow cheaper than the rate of inflation. If you can borrow money at, say, 5%, and the inflation rate is 7.6%, then at the end of the year, you're 2.6% ahead of the game. This encourages spending, which will, in turn, put upward pressure on the inflation rate, with the interest rate still low. And it's not like this inflation rate is going away anytime soon. Doug Porter, chief economist at the Bank of Montreal, noted that we are expecting to see August inflation rate to be north of 7%. And when the inflation rate is north of 7%, that is too high for anyone's comfort, and the Bank of Canada can't relax when the inflation rate is that high. So, while CIBC and others had predicted we would see a policy rate ceiling of 3.25-3.5% by the end of 2022, the release by the Bank of Canada today seems to indicate that the rates could indeed go higher. And as we saw in this video, there are multiple inflationary pressures pushing up the price of goods, which will necessitate continual rate hikes on the part of the Bank of Canada, which the bank definitely recognized in its statement released this morning. What is clear is the path of interest rate hikes will be largely dependent on the inflation rate going forward, and we're expecting to get the release of August's inflation data on September 20th. We'll obviously have updates out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.